হ্যালো সুকন্যা।
হ্যালো স্যার।
আচ্ছা আচ্ছা, ঠিক আছে। হুম।
স্যার 7টা থেকে স্টার্ট হবে তো?
হ্যাঁ হ্যাঁ হ্যাঁ, 7টা।
আচ্ছা স্যার, আচ্ছা। সুকন্যা। স্যার
Acha, okay. So, good evening to all of you, and good evening to our respected resource person of day 3, lecture number, lecture series number 4.
Good evening.
Good evening, good evening. Sir. Today, we are in the day 3 of our virtual lecture series on finance and other allied subjects for BCom undergraduate or semester students, organized by the Kolkata Bidhannagar Society for Academic Advancement. Today, we have two respected and esteemed invited speakers as well as our resource person. You can say resource person also. In the first lecture series number 4, we have Dr. Sudipta Ghosh from Maharani Kasheshwari College, Kolkata, and Dr. Sujoy Kumar Dhar in the second session, who is from ICFI Business School, Kolkata. And I'm now handing my charge to Sukanya Bhattacharya, Madam, for the introduction of our respected resource person, Dr. Sudipta Ghosh. Thank you, sir. And thank you, madam.
Thank you, sir. Dr. Sudipta Ghosh, sir, is an assistant professor in the Department of Commerce, Maharani Kashishori College, affiliated to the University of Calcutta, Kolkata. He obtained his MCom, MPhil, and PhD from University of Calcutta and qualified UGC NET. He has nearly 15 years of teaching and research experiences. He has contributed to many peer-reviewed journals, including UGC Care listed journals, and edited books and presented papers in different seminars and conferences at the national and international level. He has edited one peer reviewed multidisciplinary research volume published by the reputed publishing house. He has also worked as a reviewer of the books published by reputed publisher. Dr. Ghosh successfully completed one minor research project as the principal investigator funded by UGC. He has successfully convened one state level seminar and two national level webinars. He has also delivered lectures as an invited resource person. At present, he serves his institution in various capacities, including the head of the department, joint convener of the research cell. He is the life member of the Indian Accounting Association Research Foundation, Kolkata, Commerce Alumni Association, University of Calcutta, Kolkata, ISI Kolkata, and Kolkata Bidhannagar Society for Academic Advancement. Over to you, sir.
Thank you, Sukanya, for your welcoming address and my sincere regards to our Secretary, sir, Professor Pema Lama, sir. And I am very much thankful to our society for giving me such wonderful opportunity to provide my lecture for BCom undergraduate students or SEM students. Uh, so, sir, with your kind permission, I am now starting my lecture.
Okay, sir. Okay.
Okay, okay. Thank you, sir. So, I have a study material and I am sharing it. Sir, please let me confirm whether it is visible or not.
Sir, yes, sir, visible.
Okay, okay. Thank you, sir. Thank you, Sujanda ma'am. And thanks to all other members, dignitaries of our society, and the viewers, learned viewers, and my beloved students. So, Kolkata Bidhannagar Society for Academic Advancement has started a virtual lecture series, which is a student-centric activities. And in today's lecture, I will cover a chapter which is very much important for your upcoming examination. The name of the chapter is Accounting for Buyback of Securities. From my experience, students, I know that you may have a fear regarding this chapter, but after listening this lecture of 1 hour, I am sure that to some extent you will be confident enough to solve a problem from buyback of shares. Now, this is for 5th sem honors and general students, and it is in subject corporate accounting, and as per the syllabus of CU BCom, this is unit 2 and marks allotted 10. Now, let me clear a point first. As our examination is knocking at our door, so basically I will focus on examination purpose so that we can ready for our examination. Now, buyback means, first you have to know that what is buyback. Student, buyback means the act of purchasing its own shares by a company. We know that in company balance sheet, in equity and liability sector, in liability there is shareholders funds, and then share capital. In share capital you have equity share capital, preference share capital, like this, and company can buy back its own shares. That is considered as buyback. Now, why buyback? A company can exercise this act of buyback when it has excess capital than the required amount, than the requirement. That is, in the case of overcapitalization, company can exercise the buyback. Now, students, remember that only fully paid up shares or securities can be bought back. That means partly paid up shares could not be bought back. Now, in your examination problem, you may get that 10,000 fully paid up shares and 8,000 partly paid up shares, or 2,000 for 10,000 fully paid up shares, 2,000 partly paid up shares. On that case, you have to consider the fully paid up shares only. Now, according to the instructions of the question, sometimes you have to make a call in order to make the partly paid up shares to fully paid up. On that case, the total fully paid up shares can be considered for the buyback. Now, the shares means equity shares and preference shares, and securities means some specified securities like employee stock options. Now, I have already mentioned that our lecture will be exam oriented. So, from the buyback of securities, the heading is accounting for buyback of securities. Now, I am coming to buyback of shares, more specifically, buyback of equity shares. So, today's topic is accounting for buyback of equity shares. Now, buyback and redemptions, they are not same. They are different. Redemption is occurred as per the terms of the issue. We know that in case of preference shares, preference shares to be issued, the redeemable preference shares can be issued. Now, preference shares can be redeemed after 10 years. Okay, so the redemption will be occurred after the term, at the end of 10 years. But the buyback can be done before their redemption has become due. That means company can buy back at the end of 5th year or at the end of 6th year. Now, equity shares can be bought back but cannot be redeemed, whereas preference shares, they can be bought back as well as redeemed. Now, we are fully concentrating on buyback of equity shares. Now, the three sources of funds for buyback. A company may purchase its own shares out of three sources. Number one, free reserve. Number two, securities premium. And number three, proceeds from fresh issue of shares. Now, we will consider these 3 points again. So, this is the basic points, basic introduction of accounting for buyback of shares. And these buyback of shares, it is guided by the section 67, 68, 69 and 70 of Companies Act 2013. Now come to the journal entries. because in examination you are required to pass the journal entries. There are several journal entries. First is fresh issue of shares. Now, in case of fresh issue of shares, the actually the buyback accounting entry, this is starts from due entry, from this due entry for shares bought back. But before starting these journal entry, it is always advisable to pass these 3 to 4 entries if required. I will tell you in latter part of my lecture why these entries are required to be passed fast, because they have implication for your solution. Now, company, the fresh issue of shares, company will issue shares for the purpose of buyback. On that case, the issue may be at par, may be at premium. If it is at par, then journal will be bank account debit to share capital account. If it is at premium, on that case, journal will be bank account debit to share capital account to securities premium account. And nominal value to be considered in capital portion and premium amount to be considered in premium portion. In case of buyback of equity shares, usually fresh issue of shares means fresh issue of preference shares, because same type of shares cannot be bought back and issued at a time. So buyback and fresh issue of preference shares for the purpose of buyback. Now, new shares, that is fresh issue of shares, may be equity shares but in separate denomination. That means buyback of equity shares at rate rupees 10 each and fresh issue of equity shares at rate rupees 5 each. But in most of the problems of university examination, you will find that the fresh issue of shares, that is the preference shares. Next journal is the sale of assets. If there is any sale of any asset, you have to record journal entries for that. Like investment, investment is one important asset. On that case, the journal will be bank account debit to asset account. Now, the asset can be disposed of, may be disposed of at loss or may be disposed of at profit. So if disposed of at loss, on that case, journal will be bank account debit, loss on sale of assets account debit to assets account. And if the assets disposed of at profit, on that case, bank account debit to assets account to profit on sale of asset account. And in the next journal, we have to transfer the loss or profit on sale to profit and loss account. That means in case of loss, the journal is profit and loss account debit to loss on sale of asset account. And in case of profit, the journal will be profit on sale of asset account debit to PL account. So either profit or loss, any one. So obviously, both, that is profit and loss at a time, is never possible. This is the sale of asset entry, and as well as transfer of profit on sale or loss on sale to the PL account. Next journal, if company made a call, okay, in case of partly paid up shares, so the journal entries will be like this: call money due and received against partly paid up shares. Journal will be equity share final call account debit to equity share capital account, and then bank account debit to equity share final call account. Students, usually you say that call to capital, bank to call. That journal, call to capital and then bank to call. And you have already studied this entry in the chapter of issue of shares. So this is simple, the call money due and received against partly paid up shares. Now, after that, we have to pass due entry for shares bought back. Journal entry, equity. Now, these shares can be bought back at par, at a premium, at a discount. But I am not considering the discount case here, because in most of the examination problem, they are at premium. So it can be at par by premium. If at par, then journal will be equity share capital account debit to equity share holders account. No need to write this premium on buyback account. Okay, but most of the examination problems, equity shares bought back by the company at a premium. So on that case, journal will be equity share capital account debit, premium on buyback account debit to equity shareholders account. So nominal value in capital portion, premium amount in premium on buyback portion, and the total amount in equity shareholders account. After that, the payment to be made to equity shareholders. That means payment made to equity shareholders after buyback. The journal will be very simple journal, equity shareholders account debit to bank account. Equity shareholders account debit to bank account. This is the payment made to equity shareholders after buyback. Now, next entry, journal entry, this is the adjustment of premium money on buyback, adjustment of premium on buyback. So this entry to be done only if equity shares are bought back at a premium. If equity shares are bought back at par, then this adjustment of premium does not arise. But in most of the examination problems, specifically CU examination problem, you will find that equity shares are bought back at a premium. So obviously this premium, we cannot left this amount, we have to adjust, we have to write off this premium amount. So this adjustment of premium amount we have to make against securities premium account, profit and loss account, general reserve account, and other free reserve account. I will tell you obviously what are the examples of other free reserves. Okay, so for the time being, just consider that securities premium, PL, general reserve, or other free reserves as per the requirement we have to use. That is, they are the sources for adjusting premium of buyback. Okay, so premium, securities premium account debit, PL account debit, then if required general reserve account debit, and then if required other free reserve account debit to premium on buyback. Now, if the question is silent about the utilization of premium as well as free reserve, always first use securities premium, then PL general reserve and other free reserve. If there is any specific instruction in question, then you have to follow that specific instruction regarding the usage of these premium and reserves. But if the question is silent, then what will be our sequence of using these premium and reserves? First is premium, then profit and loss, then general reserve, then other free reserve. So in this way, we shall adjust the premium on buyback. After that, you have to make a transfer to capital redemption reserve. Capital redemption reserve. Okay. Now, why capital redemption reserve is to be created? This is the buyback of equity shares. Equity shares is one of the permanent sources of capital of the company. So buyback means you are drawing the permanent resources. So in order to restore the position, you are again issuing or you are again creating such a reserve which is permanent in nature, more or less permanent in nature, because capital redemption reserve account, it is statutory reserve and it can be utilized only for issuing fully paid up bonus shares. That means by issuing capital redemption reserve account, you are restoring the business position so far as its capital concentration is concerned. So, in capital redemption reserve to be created out of securities premium, profit and loss, general reserve, and other free reserve. The same point to be kept in mind that first we will use securities premium, then PL, then general reserve, then if required other free reserve. If there is any specific instruction regarding usage of these premium and reserve, then we have to follow that. Otherwise, this sequence we shall follow. So in this way, we will create capital redemption reserve account. Now, how much amount of capital redemption reserve to be created? The formula is very simple. The formula is CRR. This is equal to nominal value of equity shares bought back minus proceeds from the fresh issue of shares excluding premium. So from where we will get this nominal value of equity shares bought back? From the due entry. Follow the due entry. This one is the due entry of our shares bought back. So equity share capital account. The amount we will write here, that is the nominal value of equity share capital bought back minus proceeds from fresh issue of shares excluding premium. We will get it from this entry, bank account debit to share capital to securities premium, but we have to consider this figure against the share capital. This figure we have to consider. That is the proceeds from fresh issue of shares excluding securities premium. I will come to a problem, numeric problem, then it will be much clear. So in this way, we will create capital redemption reserve account. After that, in question, there may be buyback expenses. The journal will be buyback expenses to bank account. Then next entry, profit and loss account debit to buyback expenses account. So these two entries you have to pass. Okay, both entries, buyback expenses account debit to bank account, and then profit and loss account debit to buyback expenses account. If these buyback expenses provided in question, then only you have to pass this entry. Now, you have to know, this is very, very important, which reserves are considered as free and which reserves are not considered as free. The reserve considered as free, profit and loss account credit balance, general reserve, reserve fund, capital reserve, which is realized in cash. So full amount of capital reserve may not be considered as free. The amount which is realized in cash, that amount to be considered as free part, free reserve of capital reserve, free portion of the capital reserve. Capital reserve created out of reissue of shares forfeited. You know this treatment from your issue of equity share chapter, that in last entry, if there is forfeiture and the reissue of forfeited shares, then a portion to be transferred to capital reserve, that is to be considered as free portion. Whereas capital reserve created out of profit prior to incorporation, that is to be considered as not a free reserve. So which reserve is free, which reserve is not free, you have to be very careful. Another example of free reserve is dividend equalization reserve. Now free means in this context from where you are free to distribute dividend to shareholders. So PL, credit balance, general reserve, reserve fund, capital reserve realized in cash, dividend equalization reserve, they are to be considered as free. Now the reserves not considered as free, securities premium, revaluation reserve, investment allowance reserve, capital reserve not realized in cash, capital redemption reserve. Okay, so students, you have to memorize this portion. This portion is very, very important. So students, so far we have learned that the basic concept of buyback. Once again, buyback means the act of purchasing its own shares by a company, and then only fully paid up shares can be bought back. These two are most important points from this portion. Then the journal entries, and after the journal entries, the reserve considered as free and reserve not considered as free. Now, let us consider a question. Actually, I am considering the abstract of a full question. You will get this question from from the standard textbook or from the scroller we usually follow in our class. That is the bunch of questions, question book. So they are university questions. I am considering they are CUB Commoners questions. I am considering only the relevant portion. B Limited, this is a question of B Limited. B Limited wants to buy back its shares, equity shares. Now the following information, as on 31st March 2022, 8 lakh fully paid up equity shares at rate rupees 10 each, 80 lakh. And B Limited has securities premium of rupees 25 lakhs, general reserves rupees 7 lakhs, SPL rupees 4,80,000, non-current investment 10,80,000. You will get this information in this way or a balance sheet to be provided. In first lecture, Professor Mukherjee has made a detailed discussion regarding corporate financial statements, regarding balance sheet. So you know that what are the representations of this item. So securities premium, general reserve, SPL, they are the part of reserve and surplus. Fully paid up equity shares, they are the part of share capital. Non-current investment, they are the part of they are the long-term investment. Non-current investment means they are the long-term investment. On 1/4/2022, B Limited decided to buy back its 25% equity shares. So it is clearly mentioned that how much equity shares to be bought back. It is 25%. We can easily determine the numbers by applying this 25% at rupees 20 each. So nominal value of each equity share 10, whereas the buyback price is rupees 20. So this is the buyback at a premium of rupees 10. Nominal value 10, buyback price 20. So this is buyback at a premium of rupees 10. For this purpose, B Limited sold its entire investment at rupees 12 lakh and issued 8,000 10% preference shares of rupees 100 each. The company utilized 50% of the general reserve, 100% of SPL balance, and rest amount, balance amount from securities premium. Show necessary journal entries. So students, in this question, there is a clear instruction regarding utilization of reserves and securities premium. We have to solve this by keeping this point in our mind. So first, we have to pass the journal entries for sale of investment. This is 10,80,000 investment sold at 12 lakh. So obviously, it is a sale at a profit of rupees 1,20,000. So usual format of journal, books of B Limited journal, date, particulars, debit, credit, amount rupees. On 1/4/2022, bank account debit, to investment account, to profit on sale of investment account. 12 lakh, investment 10,80,000, profit on sale of investment 1,20,000. In next entry, we have to transfer this profit to profit and loss account. So profit on sale of investment account debit to profit and loss account. How much? 1,20,000. Next, we shall pass the journal entry for issue of new shares. New shares means here issue of new preference shares. So 8,000 10% preference shares of rupees 100 each. This line, follow this line, issued 8,000 10% preference shares of rupees 100 each. So journal will be bank account debit to 10% preference share capital. So 8,000 into 100, the amount is 8 lakh. Next, the due entry for buyback of equity shares. Now, the number of equity shares bought back, how much? 8,000, 8 lakh fully paid up equity shares. As these are the fully paid up equity shares, so all shares can be considered out of the 25% equity shares bought back. So 8 lakh into 25%, it comes to 2 lakh. 8 lakh into 25%, 2 lakh. So 2 lakh equity shares bought back at rupees 20 each. That means at a premium. So journal is equity share capital account debit, premium on buyback account debit to equity shareholders account. So 2 lakh shares into 10, this is 20 lakhs. The premium amount is 2 lakh shares into 10, again 10. Why 10? Because 20 buyback price minus nominal value. Buyback price 20, nominal value or face value is 10. So 20 minus 10, 10. So premium on buyback per share 10. So 2 lakh into 10, 20 lakhs. To equity shareholders, total figure 20 plus 20, 40 lakhs. Next is the payment to equity shareholders. So payment entry is equity shareholders account debit to bank account 40 lakh and 40 lakh. This is simple. Equity shareholders to bank account 40 lakh, 40 lakh. Now we have to adjust the premium money. This premium money, premium on buyback. This premium money, how much? 20,000. In this respect, we will always try to utilize the securities premium first, because securities premium cannot be utilized in each and every case of the business. So in this case, we get a scope to utilize the premium, securities premium, to adjust the premium on buyback. So we will adjust this premium on buyback, that is 20 lakhs, against the securities premium. So let us check how much securities premium available in the business. Obviously 20, this is 25 lakh, so enough amount, because premium amount is 20 lakhs, securities premium available in the business is 25 lakh. So journal will be securities premium account debit to premium on buyback account. How much? 20 lakhs. So premium amount is adjusted. Next is the creation of capital redemption reserve account, CRR, statutory reserve, which can be used only for issuing fully paid up bonus share. Now first we have to determine how much CRR is to be created. So formula is nominal value of equity shares bought back, that is 20 lakh. Nominal value of equity share bought back is 20 lakh, and the proceeds from fresh issue of shares excluding premium amount. This journal entry. Bank account debit to 10% preference share capital. This is a fresh issue. So 8 lakh. The capital money, the nominal value we have to consider. So 20 lakh, this 20 lakh minus 8 lakh. The figure is 12 lakh. For 12 lakh, we have to create CRR, capital redemption reserve account. Now, the condition is, as per question, The company utilized 50% of general reserve. So first we will utilize 50% of general reserve, that is general reserve is 7 lakh. So 50% is 3 lakh 50,000. So general reserve account debit 3 lakh 50,000. General reserve account debit sorry 3 lakh 50,000. Next, profit and loss account debit, because as per instruction given in question, 100% of SPL balance we have to utilize. Now SPL balance provided in question is 4,80,000, and another 1,20,000 is now available after selling the investment. So students, this is the benefit of passing these journal entries at first. You can identify the changes in profit and loss account. This is the sale of investment as at a profit. So the balance available 4,80,000, now it is become 4,80,000 plus 1,20,000, total 6 lakh. So now the 6 lakh profit is available for CRR transfer. But if you forget to pass this journal entry, and if you forget to consider this amount, and if you consider SPL only 4,80,000, the answer will be wrong. If investment sold at a loss, say sold at a loss of 1,80,000, on that case SPL balance we have to consider not 4,80,000 but 4,80,000 minus loss 1,80,000, so 3 lakh SPL we have to consider. So students, be careful. The amount ultimately available in profit and loss account. So as per this question, 4,80,000 as per balance sheet, and from this transaction another 1,20,000 to total 6 lakh, and 100% as per the question, 100% of SPL balance can be utilized. So we will utilize 4,80,000 plus this 1,20,000, that is 2PL account 1,20,000, that is 6 lakh. So 6 lakh PL, it is mentioned here, and I insist you to do these workings in this way. If you do these workings in this way, obviously your marks will be higher, because they will create a good impression to the examiner. Proper workings always required for accounting. So this is 6 lakh. Now capital redemption reserve to be created 12 lakh. Out of that, from general reserve 3 lakh, from PL 6 lakh, that is 9 lakh 50. Balance required is 2 lakh 50, which we can utilize from SEC premium account. Because in securities premium account still 5 lakh is available. Still 5 lakh is available. Because as per question, securities premium is 25 lakh, and out of that 20 lakh already utilized to adjust premium on buyback. So still 5 lakh is there, so we can easily utilize the SEC premium account. So this is the first question. This is a basic question to explain the concept of buyback of shares. So these are the journal entries. Now come to some advanced portion. Actually, in buyback, 3 test conditions are there. When these 3 test conditions will be important, it will be important to calculate the number of shares that can be bought back. Now, in this question, how many shares to be bought back clearly mentioned, 25% equity shares to be bought back. So we can easily determine the number, 8 lakh into 25%, 2 lakhs. But if the number of shares to be bought back, it is not provided in question, you have to calculate it. On that case, these three tests are very, very important. They are known as three test conditions. Number one, outstanding equity share test. Number two, resource test. And number three, debt equity ratio test. Try to understand them one by one. Outstanding equity share test, here we will get our answer in number, 25,000 shares or 12,000 shares or 10,000 shares like this. What is the formula? Formula is paid up equity share capital. So remember, this is equity share capital. Okay, so only equity share to be considered, not the preference shares. If in question preference shares is also there, you have to consider only equity share. Okay, so paid up equity share capital into 25%. You will get a figure divided by face value per equity share. Divided by face value per equity share. You will get a result and the answer will be number. Next is the resource test. In resource test, the formula is paid up share capital. Now here paid up share capital means equity share capital as well as preference share capital. If in question preference share capital is there, so here you have to consider both equity share capital and preference share capital. So paid up share capital plus free reserves and securities premium. Now students, you know what are the free reserves? So free reserves and securities premium we have to consider here. So add these figures into 25%. You will get an amount divided by buyback price per share. Buyback price, say it may be 20, it may be 30, it may be 10, whatever may be the buyback price, divided by buyback price. You will get a result in number. Then the debt equity ratio test, post buyback debt equity ratio, post buyback debt equity ratio shall not exceed 2:1. Now, debt equity ratio, the formula is debt by equity. Now here debt means debt equal to secured debt plus unsecured debt. Example, through example, it will be easy for us to understand the concept. Example of secured debt is debentures, and example of unsecured debt is creditors. So you have to consider both secured and unsecured debt. And the equity means this is equal to post buyback paid up share capital, post buyback paid up share capital plus post buyback free reserves and securities premium. Post buyback free reserves and securities premium. So we have to test the post buyback debt equity ratio also as per the requirement of our question. So these are three tests: outstanding equity share test, resource test, and debt equity ratio test. Now it may be that you have to determine buyback price. Okay, so per share buyback price may not be provided in question. On that case, you have to determine the buyback price per share. The formula is amount as per resource test divided by number of equity shares as per outstanding share test. So amount divided by number, as simple as this. Amount means amount as per resource test. Resource test amount will be paid up share capital plus free reserve and securities premium into 25%. That's all. And number of shares as per outstanding equity share test, paid up equity share capital into 25% divided by face value per equity share. So amount divided by number, you will get the buyback price. Consider this example. Equity share capital at rate rupees 10 each, 48 lakhs. General reserve 72 lakhs. Revaluation reserve 12 lakh. Securities premium 24 lakhs. So number one, First, number of equity shares as per outstanding share test. 48 lakhs equity share capital, so 48 lakhs into 25%. This is a fixed percentage. 25%. We have to always consider 25%. This is a fixed percentage, okay? Divided by face value per share. Face value, nominal value per equity share is rupees 10. So divided by 10. The answer is 1,20,000 shares. Their number 1,20,000 equity shares. So number 1. Number 2, amount as per resource test. Amount as per resource test, consider the formula: paid up share capital plus free reserves and securities premium into 25%. So equity share capital is 48 lakh, general reserve is 72 lakhs, and securities premium is 24 lakhs. We have to consider free reserves and securities premium. So revaluation reserve is not free. We have already discussed this portion in my previous lecture, previous part. So you will not consider this revaluation reserve. So 48 lakhs plus 72 lakhs plus 24 lakhs into 25%. It is coming as 36 lakhs. Now 36 lakh divided by 1,20,000. This is the rupee figure and this is the number figure. The answer is rupees 30. So buyback price is rupees 30. Buyback price per share, maximum buyback price per equity share rupees 30. Now the conditions of debt equity ratio, that is post buyback debt equity ratio, shall not exceed 2:1 to be verified, considering the buyback of 1,20,000 shares at rupees 30 each. So primarily we get number of shares could be bought back 1,20,000 and maximum price per share 30, buyback price per share 30. Now we have to check the post buyback debt equity ratio also. So through this process we can determine the buyback price also. Now let us consider another question. P Limited has the following information as on 31st March 2022. 50,000 equity shares at rate rupees 10 each, 5 lakh. 2,008% preference shares at rupees 100 each, 2 lakh. Securities premium 1 lakh. General reserve 1,75,000. Dividend equalization reserve rupees 75,000. PL balance, profit and loss account credit balance 1,50,000. Capital reserve not realized in cash 1,50,000. That is, it is not a free reserve. 9% debentures 5 lakh. Bank loan 3 lakh. Creditors 1,75,000. Students, I am taking the abstract of the full question. You will get a balance sheet along with notes to accounts. But here I am considering the information required for our discussion, that portion only. But in examination question, usually you will get a balance sheet along with notes to accounts and other necessary information. Now P Limited wants to buy back its equity shares. How many equity shares can be bought back at which price? So number of equity shares to be bought back not known, and at which price, that is also not known. So first what we have to do, first we have to apply the outstanding equity share test. Outstanding equity share test, paid up equity share capital into 25% divided by face value per equity share. So Just follow the question again. 5 lakh into 25% divided by rupees 10. So it becomes 12,500 shares. It becomes 12,500 shares. Now the resource test. You have to consider paid up capital plus free reserve and securities premium. Total figure into 25%. Now paid up capital means equity capital as well as preferential capital. So in this question, equity capital is 5 lakh and preferential capital, paid up preferential capital is 2 lakh, total is 7 lakh. So that's why I am considering here 7 lakh paid up capital plus free reserves and sec premium. Free reserve, first is general reserve 1,75,000. Dividend equalization reserve is 75,000, so 2,50,000 plus SPL 1,50,000, that is 4 lakh. This is reserve portion. We cannot consider capital reserve as it is not realized in cash, so this is not a free reserve. So 4 lakh is free reserve and sec premium, securities premium is 1 lakh. Total is 5 lakh. So 5 lakh. Total is 12 lakh into 25%, so 3 lakh. Now buyback price per equity share. So amount as per resource test divided by number of shares as per outstanding equity share test. 3 lakh divided by 12,500 shares becomes rupees 24. So rupee 12,500 shares could be bought back at rupees 24. Now the verification of post buyback debt equity ratio. If post buyback debt equity ratio is becoming 2:1 or less than 2:1, then 12,500 shares at rupees 24 could be bought back. So let us verify this. Debt is, let us consider the debt first. Debt is 9% debentures. This is secured. Bank loan is also secured because bank provided loan against mortgage. So this is 3 lakh. It is secured loan. And in your question, if you get bank loan under non-current liabilities, obviously they are long term, they are secured. So loan is secured, debt is 5 lakh plus 3 lakh, 8 lakh. And unsecured portion, that is creditors, is 1,75,000. This is creditors is current liability. So 8 lakh secured portion and 1,75,000, it is unsecured portion debt. So total debt is 9,75,000. Now the post buyback equity. Post buyback equity means paid up capital plus free reserve and securities premium. Now consider this portion very carefully. Paid up capital, that is the equity capital, it was 5 lakh. After buyback, 12,500 shares at rate rupees 10 will be no more in business. So that's why minus 12,500 shares into nominal value per share, that is 10. As this is the capital portion, we are considering the nominal value only. So 5 lakh equity capital minus number of shares bought back into nominal value per share plus preference share capital. As per question, preference share capital, it is 2 lakh. So this portion is paid up capital portion, post buyback paid up capital portion. Now the free reserve and securities premium in pre-buyback situation was rupees 5 lakh. This one, sec premium 1 lakh, general reserve 1,75,000, dividend equalization 75, SPL 1,50,000. If you add them, you will get 5 lakh. But do not consider capital reserve because we have to consider the free reserve. This is 5 lakh minus the amount utilized for this purpose. Amount utilized for this purpose, this is 12,500 shares into rupees 24. That is the buyback price. So you have to multiply these by buyback price. Now, student, you may ask a question, sir. Due to buyback, one reserve has already been created, which is known as capital redemption reserve or CRR. Should we consider that CRR created through this buyback? The answer is no, because CRR is not considered as a free reserve. So the 5 lakh free reserve and securities premium minus number of shares bought back into buyback price per share. After that, you will get the post buyback equity amount, which is 7,75,000. I hope this portion is clear. To some extent advanced knowledge, to some extent tough, but if you go through, I am sure that you can understand this. Now, post buyback debt equity ratio is debt 9,75,000 divided by equity 7,75,000. So it is becoming 1.26:1. That is, it is within 2:1. So 12,500 shares at rupees 24 each can be bought back. So students, this is my today's lecture. In this lecture, step by step, we studied the basic concept, the journal entries, and we also came to know about the conditions, 3 important conditions, and we have considered 2 problems. Now, this is for test of your knowledge, test your knowledge. Number 1, in buyback of securities, the sources for payment of capital are: number A, free reserve; number B, free reserves and securities premium; number C, free reserve, securities premium and proceeds from fresh issue of shares; and number D, securities premium and proceeds from fresh issue of shares. Obviously, the answer will be C. Free reserve, securities premium and proceeds from the fresh issue of shares. At the beginning of my lecture, I have already mentioned it. Three sources of funds for buyback. Okay, a company may purchase its own shares out of free reserves, SEC premium, securities premium, and proceeds from fresh issue of shares. Question number 2. 10,000 equity shares, face value rupees 10, bought back at a premium of rupee 1. This is rupee 1, not rupees 1, rupee 1. So buyback price is rupees 11 per share. No fresh issue is made for this purpose. Maybe. No problem. So how much to be transferred to CRR? So the nominal value of equity shares bought back, this is 10,000 shares into rupees 10. That means 1 lakh. So 1 lakh amounting to rupees 1 lakh to be transferred to CRR. Because there is no issue, no fresh issue. So the 1 lakh amount to be transferred to CRR. And obviously the source will be SEC premium, PL, general reserve, other free reserves. The securities premium and reserve amount available in question. How much to be paid to equity shareholders? This is very easy. So equity shareholders, we have to pay 1 lakh equity shares into buyback price, that is 11. That is 1,10,000. So 1,10,000 to be paid to equity shareholders. So with this, this is my presentation. So
Thank you, sir.
Who is available here? Please take the charge now.
Thank you, sir. The session was really very useful and very interesting. Thank you so much, sir. Hope to hear from you soon.
Okay, thank you.
Thank you so much, sir. Thank you once again.
Okay,
Thank
okay.
you. Thank you, sir. Thank you very much, sir.
Thank you. Actually, I made this presentation in a lucid way and totally students oriented lecture. It
Yes, sir.
was.
Yes, sir.
Thank you, sir. Thank you
Thank
once
you.
again.
Sukanya, next, wait.
Next, sir. Yes.
Sujata, yes.
So the next session will be taken by Dr. Sujoy Kumar Dhar, sir. Dr. Sujoy Kumar Dhar, sir, is a faculty member of ICFAI Business School, Kolkata. His core area of experience is finance, economics, and control. He has more than 16 years of teaching experience. He has obtained his degree of Doctor of Philosophy, PhD, in Commerce from the University of Calcutta, and his title of the thesis is A Study of the Corporate Governance Practice in the Indian Banking Sector. He has done MSc in Economics with specialization in Econometrics and Statistics from University of Calcutta. He has also done his MBA with Finance specialization from IISWBM under the University of Calcutta. His area of research interest is capital market, banking, and the corporate governance. Professor Dhar is a member of the Federation of the Indian Professional Trainers. He has authored a derivative book named as Investment Strategies for Individual Investors by ICFAI University Press in 2008. He has also authored a book titled as Marketing the Financial Services to the Unbanked Population, published by the Lambert Academic Publishing in 2013. He has also authored a book titled as Corporate Governance Practices in the Indian Banking Sector and its Several Perspectives, published by the Vandana Publications in the 2022. He has more than 65 research publications in different national and international reputed journals. He has also attended and presented research papers in different national and international seminars as well as conferences. Over to you, sir.
Thank you so much, madam.
Thank you, sir.
So, very, very good evening to all of you. Now I will present on measurement of central tendency. I hope screen is visible to all of you.
Yes, sir, the screen is visible.
Yeah. So I will discuss on the topic measurements of central tendency. Now, why I have chosen this topic, frankly speaking, that central tendency, it is the foundation stone of the statistics, because central tendency is measuring the average. Now, why average is important? Why average is important? From our childhood, irrespective of our specialization, we have learned this: average height, average weight, average income, average IQ level, average percentage of marks. So average is nothing but a benchmark. So if I'm saying average income is 70,000 per month, that means who are earning more than 70,000? They are above average. Who are earning less than 70,000? They are below average. If I'm saying average marks is 70%, who have scored more than 70%? They are above average. Who have scored below 70%, they are the above average, below average. So average is the benchmark. Now central tendency will discuss what are the different methodologies to compute the average. So one by one. Central tendency is the middle point of distribution. And obviously it is talking about average. Now, what are the different methods of measuring the average? Mean, median, and mode. Means are of three types. All of you know: arithmetic mean, geometric mean, and harmonic mean. Now, when I am talking about arithmetic mean, irrespective of our academic background, from our school life, this is the thing we have learned. What is arithmetic mean? That is sum total of the observations divided by number of observations. So if you see, specifically when I'm talking about non-frequency data, what is non-frequency data? That is general number, 10, 20, 30, 40, 5,000 to 10,000. So non-frequency data is x bar is equal to summation x by n. That means if there are 10 students, their marks is given, and you have to calculate the average marks of 10 students. So we have to add the 10 students' marks and divide it by number of students, that is 10. So non-frequency data, if you look, AM is equal to summation xi by n. Summation xi is sum total of the observations, n is number of observations. But once it is frequency data, now question will come to your mind. What is frequency? Whether it is item to be consumed during the breakfast or it should be taken during the bath. Frequency, frankly speaking, it is the number of occurrence of a particular event. Suppose if I am saying number of telephone call received in Calcutta University campus on 14 December 2022 from 12 noon to 3 p.m. That is frequency. So number of occurrence of event. Let me give you another example. Suppose you are saying age of the boys as well as number of the boys. Suppose you are defining X and F. Let me just show it so that all of you can understand. Let me work over here. I'm taking an additional sheets. If you look, suppose I'm defining X as age of students in Karunamoi, Salt Lake, where I reside. And F is number of students. All of you are able to see the screen, I'm sure. So X and F. If I'm saying X is 15, frequency is 50, and X is 16, frequency is 30. That means 50 students are there in Karunamoi Salt Lake who are 15 years old, and 30 students are there in Karunamoi Salt Lake who are 16 years old. So what is frequency? Frequency is number of occurrence of a particular event or number of repetitions. Now, so when it is a frequency data, what will happen? Formula is summation fx by n. N is the sum total of frequencies. Now, let me take the help of one example. Calculate the weighted mean price of a table following the data, assuming that weights are proportional to number of tables sold. So, price per table, it is given, and number of tables sold, it is given. Price per table is 36, 40, 44, 48. Number of tables sold, 14, 11, 9, 6. So what is your takeaway from this frequency distribution? If I ask you the question, 14 tables have been sold at 36 rupees price. 11 tables have been sold at 40 rupees price, and so on. So you have to calculate the weighted mean price. So what will happen? Price per table I am defining as x variable. Number of tables I am defining as f. So f into x. 36 into 14, 504. 40 into 11, 440. 44 into 9, 396. 48 into 6, 288. So number of tables sold, 40. Summation fx, 1628. So weighted arithmetic mean is 1628 by 40, 40.7. Tell me, up to this, anybody has any doubt, any problem? You can unmute yourself, you can talk, you can write in the chat box. Is there any problem up to this? Okay.
Sir.
Yeah. Yeah, ma'am.
So there's no problem.
Okay. Thank you. So, given the following frequency distribution, calculate the mean wage of workers. Look, here monthly wages have been given and number of workers have been given. Suppose this monthly wage, I'm just changing it little bit. Monthly wage, suppose we are talking about in terms of 1,000. That is, my unit of measurement is 1,000. That means there are 2 workers who will get 12,500 to 17,500 wage. There are 22 workers who will get 17,500 to 22,500 wage, and so on. So what will happen again? Now this time, what's the difference with the earlier? Earlier, if you see, it was a frequency data. This time also it is frequency data. But earlier we have done, it was simple frequency data. Because what is simple frequency data? Simple frequency data means, let me write here. Simple frequency data implies simple frequency data implies when a particular value is assigned with a frequency. When a particular value of variable is assigned with a frequency. This is called simple frequency data. And there is also another concept which is known as grouped frequency. It implies when a class interval is associated with a frequency. So simple frequency means when a particular value of variable is assigned with a frequency, and group frequency means when a class interval is associated with a frequency. Now if you look, the first problem what I have discussed, it is the example of simple frequency, because price per table, here each value of the variable, when variable value is 36, it is associated with frequency 14. When variable value is 40, it is associated with frequency of 11, and so on. So this is nothing but simple frequency. Simple frequency, what we have done? F into x, then summation of x by n. But if you come to here, this example, workers example, this time it is a group frequency, because a class interval is associated with the frequency. So first we have to take the mid value. Mid value means lower interval plus upper interval divided by 2. So 12.5 plus 17.5 by 2, it is 50. 17.5 plus 22.5 by 2, it is 20, and so on. Then you are using the same formula. Summation of x by summation f. So number of workers is f, mid value is x, so f into x, 1780 by 63. So weighted arithmetic mean is rupees 28.25. So please try to understand. Once again, if I come back, when it is grouped frequency requires a midpoint, without which we cannot work. And what is midpoint? Midpoint is average of lower and upper class interval. I hope I am clear. So now let me come to composite arithmetic mean. Now question will come, what do you mean by composite arithmetic mean? That means if there is a more than one group and number of observations as well as arithmetic mean of each group is known to us, so we can calculate the arithmetic mean of the combined group. So if I'm assuming first group contains n1 observations and it has arithmetic mean of x1 bar, second group contains n2 observation and it has arithmetic mean of x2 bar, so arithmetic mean of combined group is x bar. So nx bar is equal to n1 x1 bar plus n2 x2 bar, where x bar is equal to n1 x1 bar plus n2 x2 bar divided by n1 plus n2. Let's take one example. Theoretically, we will not understand. There are two branches of an establishment employing 180 persons respectively. If the arithmetic means of monthly salaries paid by two branches is 275 and 225 respectively, find the arithmetic mean of the salaries of the establishment as a whole. So there are more than one group. N1 is 100, N2 is 80, X1 bar is 275, X2 bar is 225. See, N1 100, N2 80, X1 bar 275, X2 bar 225, N is 180 and X bar. So Nx bar is equal to N1 X1 bar plus N2 X2 bar. So 180 X bar is equal to this. So X bar is equal to 252.78. Am I clear? This is called composite arithmetic mean. That means what? When you have more than one group, suppose you have 3 sections. There are 3 sections in a class. Section A contains 80 students. Section B contains 90 students. Section C contains 70 students. And average marks of economics of section A is 60. Section B is 65. Section C is 63. What will be the combined average? N1, N2, N3, you know. X1 bar, X2 bar, X3 bar, you know. So it will be Nx bar is equal to N1 X1 bar plus N2 X2 bar plus N3 X3 bar divided by Nx bar. I hope, am I clear? Anybody has any doubt, any question? Now, why arithmetic mean? What are the advantages of arithmetic? Arithmetic mean is readily understood, hence needs no explanation. Computation of arithmetic mean is easy. From our childhood, whenever we are thinking about average or mean, we are doing arithmetic mean. Sum total of the observations divided by number of observations. And it can be calculated without arranging the data in order. So, what is without arranging the data in order? So, let me give you the example. Suppose if you are saying aim of 30, 20, 12, obviously they are not in the order, but I need not arrange the data in order. I can directly add them and I will divide by number of observations. I need not ensure whether they are following ascending order or descending order. So order of the observation does not matter. That means in this case, what will be the aim? 30 plus 20 plus 12 by 3. So 62 by 3. Now you may say, fine sir, it is a descending order. Fine. Now even if you do ascending order, say aim of 12, 20, 30. Do you think mean will change? Never. Because ultimately you will add these same values and you will divide. So this is the thing. So everywhere you will get the same value. So there is no need of changing it. Therefore, it can be calculated without arranging the data. It can be treated algebraically. Now, what is algebraical treatment? Given the aim and the number of observations in several groups, aim of the composite group can be calculated. So, if number of observations and arithmetic mean of each group, if number of observation and arithmetic mean of each group is known to us, I can calculate the combined average. Am I right? Just now I have given you the example. If there are 3 sections, section A, 70 students. Average marks of A, 60. Section B, 80 students. Average marks of B, 65. Section C, 90 students. Average marks of C, 68. I can calculate the combined average of all the three sections, because what will be the combined average? Combined average will be 70 into 60 plus 80 into 65 plus 90 into 68 divided by 70 plus 80 plus 90. So, if there is more than one group and number of observation in each group and the arithmetic mean of each group is known to me, I can calculate the combined average. So these are so many advantages. It's very stable. Now, what are the disadvantages of arithmetic mean? Arithmetic mean cannot be obtained by inspection. You have to calculate it. It cannot be calculated unless and until exact magnitude of all the observations and their number is known accurately. That means when I'm talking about 30, 20, 12, if in any observation, if I know 30, 20, I don't have the idea about the third observations, I cannot calculate the arithmetic mean because it is based on all observations. On the other hand, if you look, what else? It is heavily influenced by a large number. Let me give you the example, you will be able to understand. If arithmetic mean of 6, 7, 8 and 100, what will happen? 6, 7, 8 and 100. So AM will be 6 plus 7 plus 8 plus 100 divided by 4. That means 121 by 4. That means 30.25. Don't you think this arithmetic mean is solely influenced by these extreme observations? 100. Otherwise, rest are 6, 7, 8. How it is coming to 30.25? That means arithmetic mean is heavily influenced by extreme values. Now, let's see how to overcome these loopholes. Next is geometric mean. Geometric mean, when I'm talking about non-frequency data, it is G is equal to x1, x2, xn to the power 1 by n. That is product of n observations, its nth root. And frequency data is x1 f1, x2 f2, xn fn whole divided by 1 by n. So, if you look, let me take the example. Please remember here, don't be afraid. But to manage the geometric mean, you have to understand the applications of logarithm. Believe me, logarithm is not a Latin Hebrew. Just 3 formula I will require. When there is an addition of log, it will be multiplied. Log x plus log y, log xy. When there is a subtraction of log, it will be divided. And log x to the power n, it is n log x. Now, see, G is equal to x1, x2, xn whole to the power n. Now, if I'm taking both side log, so what will happen? Just try to understand here. Once again, let me explain. Here I am taking both side log. Log G. Let it. Log this x1, x2 whole to the power n. Now, just refer to the third formula. What is it? Log x to the power n. When there is a power, it is coming as multiplication, n log x. So what will happen here? Log x1, x2, xn whole to the power 1 by n. So 1 by n into log x1, x2, xn. Then what I have said, when there is an addition, it will be multiplication. Log x plus log y, it will be log xy. So 1 by n log x1, log x2, log xn. So log g is equal to 1 by n summation log x. G is equal to antilog of 1 by n summation log x. So this is my final formula. See, I can directly give you the formula of geometric mean. But believe me, I believe, please remember, there is a technical difference between a electronics engineer and television mechanic. Why I'm giving the example? Because if you go to a television mechanic knows which part is functioning for what. And if your television is not working, mechanic will come. It will replace the parts. But if you ask the programming, television mechanic cannot say anything about that. But electronics engineer knows the programming, knows the logic. But obviously, they will not come to your house as a television mechanic. So once you are studying in graduation or post-graduation, so you should not learn only how. How means methodology. But you should also learn why. What's the logic? Why formula is such? Why G is equal to? Why it is log G is equal to 1 by n summation log x? Or G is equal to antilog 1 by n summation log x? Is it due to the fact that it is written in the book? Is it due to the fact that it is given in the wiki? Is it due to the fact faculty has taught like that? No. This is the logic. Similarly, if you see the frequency data, G is equal to x1 to the power f1, x2 to the power f2, xn to the power fn whole divided by 1 by n. Now you are taking log in both sides. So log G is equal to 1 by n, log x1 to the power f1, x2 to the power f2, xn to the power fn. Now, once you are using log, so what will happen? Multiplication will be addition. Log x1 f1 plus log x2 f2 log xn fn. So f1 log x1 plus f2 log x2 plus fn log xn. That means log G is equal to 1 by n summation f log x. Or G is equal to antilog of 1 by n summation f log x. So this is the logic. Now if you ask me, sir, whether I have to remember the derivation, no. But you should understand. If you know the logic, you need not remember the formula. Even if you forget the formula, you can derive. Let's take the example. Find the geometric mean of 12, 14, 16, 18, and 20. Tell me, it is what type of data? Non-frequency on frequency. Obviously, it is non-frequency data because it is pure number. So what we are doing? We are creating two tables, x and log x. X 12, 14, 16, 18, 20. Log x, log 12, value is 1.0792. Log 14, value is 1.1461, like that. So summation of log x, you are getting 5.9857. Now log g is equal to 1.1971. So why it is 1.1971? Because 5.9857 divided by n. So it is 1.1971. But I don't require log g, I require g. So I have to use antilog of 1.1971. So you are getting 15.74. Now, this is non-frequency application I have shown. Let's see what is the frequency data. Apply the geometric mean to find the general index from the following group of indices by assuming the given weights. Group index are given 118, 120, 97, weights are given 412. Group index have been given, weight has been given. So log x, log 118, 2.0719. Log 120, 2.0792. Log 97, 1.9868. Log 107, 2.0294, and so on. And then f log x, 4 into 2.0719, 1 into 2.0792, 2 into 1.9868, so on. So summation f log x is 40.6803. What is the summation of f? 4, 1, 5, 2, 7, 13, 18, 20. So log g will be 40.6803 by 20. 2.034, but I don't require log g, I require g. So antilog of 2.034. G is equal to 108.1. Clear? How to calculate geometric mean for non-frequency as well as frequency data. Now another example. The production of Portland cement has increased from 99 barrels, from 99 million barrels in 2007 to 176 in 2014. Once again, production of Portland cement has increased from 99 million barrels in 2007 to 176 million in 2014. Assuming that production has increased at a constant annual rate, find the average annual rate of increase. So A is equal to P into 1 plus I to the power n. So 176 A, 99 P, 1 plus I to the power 7. So log 176 is equal to log 99 plus log 1 plus I to the power 7. Any power, it will come as multiplication, 7 log 1 plus I. Log 176, its value is 2.2455. Log 99, its value is 1.9956 plus 7 log I. So 7 log 1 plus I is equal to 0.2499. Log 1 plus I is equal to 0.2499 by 7. So log 1 plus I is equal to 0.0357. Now 1 plus I if I get, it will be antilog of 0.0357. So if you look, let me show you this antilog of 0.0357 is nothing but 1.086. Now if it is 1.086, that means I, it is 8.6%. That means geometric mean is used when you have to calculate average rate, average ratio, average percentage. This is the application. Now, what are the advantages of geometric mean? First advantage is that geometric mean is not affected very much by the presence of extremely large and small values. What was the fallacy of AM? And given the product and number of observations, GM cannot be calculated even if, sorry, my bad. Given the product and number of observations, GM can be calculated even if magnitude of each observation is not known individually. So if the product of the observations and number of observations are known to us, so we can easily calculate the GM even if magnitude of each observation is not known. GM is particularly suitable for averaging rate, ratio, and percentages. Just now I've discussed. GM is not affected by the presence of extremely large and small values. GM can also be treated algebraically. What do you mean by algebraic treatment? If there is more than one group, number of observation and geometric mean of each group is known to us, so geometric mean of the combined group can be calculated. What are the disadvantages? Significance of GM is not easy to understand. You do the product, you do the logarithm. It cannot be calculated when if any of the observation is zero. It cannot be calculated if any of the observation is zero. Because if any of the observation is zero, product will become zero. And it is difficult to calculate. Just try to understand. When arithmetic mean, if your one observation is zero, there is no problem. But in geometric mean, if your one observation is zero, product will become zero. Now, harmonic mean, HM. Now question will come, when harmonic mean will be used? When you are giving smaller weight to larger observation. Larger weight to small observations, you will use harmonic mean. Now question will come, sir, what you are talking about? Smaller weight to larger observations, how it is possible? Let me give you the example. When I am saying he or she is the first boy or first girl of the class, whether one is superior, first is superior, or 10th boy or girl is superior, obviously first. So here we are giving more weight to the lesser value. Then harmonic mean. Because harmonic mean formula is non-frequency data n divided by summation of 1 upon observation. That is reciprocal of the observation. So n by 1 upon x1 plus 1 upon x2 plus 1 upon xn. For frequency data, h is equal to n by summation f by x. N by summation f1 x1 plus f2 x2 plus fn xn. Now let me give you a simple example. When I have to go for arithmetic mean, when I have to go for harmonic mean. A man traveled, just look two examples. A man traveled 12 miles at 4 miles per hour, 10 miles at 5 miles per hour. What was the average speed? And a man traveled 12 hours at 4 miles per hour, again 10 hours at 5 miles per hour. What was the average speed? Now you may think what the person is saying. It seems both are similar. No. Just look. In first case, distance has been given as well as miles per hour is given. In second case, time covered has been given as well as miles per hour has been given. Please remember, students, if, let me give you another thumb rule. Let me give you another thumb rule. What is that thumb rule? it is such, if x per unit of y is given, x is known, use harmonic mean, y is known, use arithmetic mean. Now let me give you the example. Miles per hour. First, what has been given? Miles. So harmonic mean will be used. Here, miles per hour. What has been given? Hours. So arithmetic mean will be used. So x45 frequency is 1220 because 12 miles per hour you are traveling 12 miles at 4 miles per hour and you are traveling 10 miles at 5 miles per hour. So actually 12 and 10 is your frequency and x is variable is 4 miles, 5 miles. So 12 by 4, 3, 10 by 5, 2. So f by x, 5. And here it is 22. So average speed is 4.45 miles per hour. Now, when? Now come to the second problem. 12 hours at 4 miles per hour. 10 hours at 5 miles per hour. Here hour is given, so arithmetic mean. So fx 4 into 12, 48, 5 into 10, 50, 98 by 22. So average speed is 4.45 kilometer. Now, what is the advantages of arithmetic mean? HM will be used, or it is advantageous when it is desired to give higher weight to smaller observation, less weight to larger observation. It is used in averaging time, rate, and price. What are the disadvantages? It is very abstract in nature. And last but not the least, if any one observation is 0, you cannot calculate arithmetic mean, because what? 1 upon 0, it becomes infinite. So mean we have done, arithmetic mean, geometric mean, harmonic mean. Anybody has any problem, any question, you can ask me. Then next is median. Median, it is a set of observation, is the middlemost, median of a set of observation is the middlemost value when the observations are arranged in order. So just now I have said, for mean I need not arrange the observations in order, but median I have to. Let me take the examples. I am starting with non-frequency data. Find the median of 25, 30, 12, 300, 200. At the outset, observations are arranged in ascending order. 12, 25, 30, 200, 300. Number of observation is 5. So median is 30. Find the median of 25, 30, 12, 18, 300, 200. At the outset, observations are arranged in order. 12, 18, 25, 30, 200, 300. So number of observation is 6. But this time there is no single middlemost value. There are two values which are there in average. So 25 and 30, I will take its average. So median is 27.5. So non-frequency data median, first we have to arrange it in the order. Then if the number of observation is odd, middlemost value. If number of observation is even, we are taking two central values. Now, table below gives that diastolic blood pressure of 250 mm. The readings were made to the nearest millimeter and the central value of each group is given. So blood pressure 60, 65, 70, 75, 80 and so on. Number of men 4, 5, 31, 39, 114 and so on. So now you have to calculate the median. Now first, just try to understand. Here we have been given the blood pressure, central value has been given. So from the central value, we are calculating class intervals. Now what's the difference between 65 and 60? 5. You can take 70 and 65 also, same thing, 5. 5 divided by 2, how much it is? 2.5. So 2.5 we were deducting, 2.5 we were adding. So 57.5 and 62.5. 62.5 and 67.5. 67.5 and 72.5. And frequency has been given. Now we have to go for cumulative frequency. What is cumulative frequency? Gradually we are adding back the frequency. 4, 9, 40, 79, 193, 223, 248 and 250. Gradually we are adding 4 plus 5, 9, 9 plus 31, 40, 40 plus 39, 79, 79 plus 114, 193, 193 plus 30, 223, 223 plus 25, 248, 248 plus 2, 250. So median value is L1 plus N by 2 minus F by Fm into C. So lower class boundary of the median class, N is sum total of the frequency, Fm is frequency of the median class, C is class width of the median class. This is the formula. Now what is the median class? If you see N is 250, what is N by 2? 125. 125 is lying between 79 and 193. That means corresponding to 77.5 and 82.5. So 77.5 and 82.5, this is the median class. Now formula is L1 plus N by 2 minus F by Fm into C. So 77.5 plus 125 minus 79 by 114 into the class width of the median. Class width of the median, it is difference between upper and lower, that is 5. So 77.5 plus 125 minus 79 by frequency of the median class 114 into common class width, that is 5. So median is 79.52. Now, what are the advantages of median? Median is very easy to be understood. First you arrange the orders, then the middlemost value. It is easy to calculate also. And very easy because even if all observations are not known. So suppose there are 20 observations. I don't know the beginning to first 2 observations, last 2 observations. But I have the central observations. I can calculate the median. So even if all the observations are not known, median can be calculated provided general location of all the observations and values near the middle are available. But there are disadvantages also. First, it has to be arranged in order. In case of mean, it was not required. If you don't arrange the data in order, you cannot calculate median. Like AM and GM, median cannot be treated algebraically. What do you mean by that algebraically? That means if there is more than one group, number of observations of each group and median of each group is known to you, you cannot calculate the median of combined group. If you want to give greater importance to smaller observation, or lesser importance to larger observation, median is undesirable. And median is affected by more sample fluctuation. So this is the problem of median. Now median I have done. Next is another example, let me do you. That is mode. So central tendency, there are three classifications: mean, median, mode. Under mean, arithmetic mean, geometric mean, harmonic mean. Now, what is the mode? Mode of a given set of observation is the value which occurs with maximum frequency. Mode is equal to L1 plus D1 by D1 plus D2 into C. L1 is lower class boundary of the modal class. D1 is difference between the highest frequency and frequency of the preceding class. D2 is difference between the highest frequency and frequency of the following class. And C is equal class width. Let's take one example. See here. Wages have been given, number of employees have been given. That means there are 8 employees whose wages are 50 to 59.99. 10 employees whose wages are 60 to 69.99, and so on. So it's a class interval. But remember, when it is class interval, first I have to convert it into class boundary. How to calculate the class boundary? Any lower class interval minus previous upper class interval. 60 minus 59.99 divided by 2. So 0.01 divided by 2. So 0.005. So this 0.005 you are subtracting from lower, you are adding from upper. So 49.995 to 59.995, 59.995 to 69.995, like that. Now you tell me what is the mode? Mode is the value which occurs with maximum frequency. So what is the maximum frequency here? 16. So modal class is 69.995 to 79.995. Now what is the formula? Formula of mode is L1, lower class boundary of the modal class, 69.995, plus D1. D1 is difference between the highest frequency and frequency of the preceding class, 16 minus 10. Here it is D1, 16 minus 10 plus D2, 6. Difference between the highest frequency and frequency of the following class into 10. So it is 77.5. Now, what are the advantages of mode? From simple frequency distribution, mode can be obtained by inspection. You need not calculate. There is no calculation is required. It is unaffected by extreme values. What are the disadvantages of mode? Mode has no significance unless and until a large number of observation is available. It is a peculiar measure of central tendency. When all values occur with equal frequency, there is no mode. If 2 or more values have the same maximum frequency, there is more than one mode. And for calculation of mode, data must be arranged in form of frequency distribution. That means for non-frequency data, you cannot calculate mode. And mode cannot be treated algebraically. That means if there is more than one group, number of observation in each group and mode of each group is known to you, you cannot calculate mode of the combined group. So, if you see, I have discussed today what are the classifications of central tendency: mean, median, mode. Means are of 3 types: arithmetic mean, geometric mean, harmonic mean. So, this is my presentation for the day, central tendency. Hope you have understood. Thank you for your patience hearings. If there is any question, you can ask me. So, stop.
Thank you, sir. The session was really very interesting and it was really very useful. Hope to hear from you soon, sir. Thank you so much, sir.
Thank you so much, madam. Thank you.
And thank you, sir. Thank you. Thank you very much, sir.
Thank you so much, sir. It is my pleasure.
Okay. So, sir, thank you. Good night.
Thank you. Good night, sir. Thank you.
Sir, Tata, sir. স্যার আপনি মিউট আছেন, আপনি কি বলেন বুঝতে পারলাম না।
আচ্ছা, থ্যাংক ইউ।
থ্যাংক ইউ স্যার, থ্যাংক ইউ স্যার।
ওকে,
টাটা স্যার।
টাটা।